I want to just chat briefly about the other side of this trade, and that's the risk side of this trade, Matt. Where do things like tariffs fit in? I mean, it seems like things like industrials and maybe consumer staples that have to deal with prices overseas could be hurt by tariffs, importing stuff. And yet I look at broad industrials last week flows. I look at transport ETFs, and you've got some of them. They all saw inflows here. Can you sort this sort of contradiction out for us, Matt? John, I'll get your thoughts too.
Yeah, I think on the tariff-related impact, still we don't know where the tariffs are going to be placed. Again, a lot of these are proposed policies, and there will be a lag effect associated with them. I think on balance, the losers of this idea of more onerous tariffs around the world are non-US equities, and we saw that take place quite significantly in terms of market returns, but also flows. Non-US equity exposures have had outflows ever since the election. I think internally in the US, I think all else equal, those policies are here to, say, protect US manufacturing, and that should impact the sort of reshoring trend that we have seen and bring more domestic lines of support and supply chains, which could be beneficial on balance to all of small caps. On a sectoral basis, transportation stocks that do have those US dominant supply chains, the more mid and small cap exposures in the transportation network, not these large conglomerate transportation firms, those mid and small ones might be able to benefit from that reshoring and more domestic spending and more domestic manufacturing. But it's still a little left to be desired in terms of how it impacts industrials writ large. I would say that the biggest loser, though, of these tariff potential policies would be just non-US equities, because there's a lot of history and precedent within the last go around.
Gee, we were just hoping that overseas might open up a little bit more, but you can't help but agree with them. So Mexico, there's what is it, EWW, the Mexico ETF, the Canada ETF, maybe the China ETFs. There are many of them out there. Those are obvious concerns that are out there, and yet, I don't know. They've been terrible performers this year. Any of the China ETFs have been terrible performers. Can we make any case for owning any outside? Basically, the world just flees to the United States for everything. Europe's underperformed again this year, even though it hasn't been terrible, but it's still underperforming. I'm trying to figure out, where does an international portfolio fit in the age of potential tariffs?
Yeah, it's been a long way, for U.S. equity markets. I mean, I sort of agree. I think that, the tail risk is that, obviously, Trump, a lot of these policies could be very inflationary. I think you have to pick and choose, and I kind of, I'll point to what Matt was saying. I think small cap industrials make more sense than more large cap industrials. Listen, it's been a tough way the last 5-10 years for non-US equities, but you can't help but think that, pro-growth, pro-domestic policy, by a red sweep, would benefit more kind of small caps. I would just caution, bond investors too. The deficit's already pretty big. When Trump was in office in 2016, deficit as a percentage of GDP was 3%. Now our deficit as a percentage of GDP is more 6.3%. So ironically, a lot of what is being talked about what he wants to do will be inflationary in general. So I think you have to, be careful if you own bonds for sure. But we're overweight the U.S. I think that's the playbook, the right playbook, in the next few years until the midterms. Right, we have 2 years of kind of where he can control a lot of the narrative.
Right, Matt. What about, John was mentioning bonds? This seems very tricky right now. We saw inflows into the broad bond categories last week, like AGG, which is the broad one, the biggest broad ones, the Vanguard bond, total bond. There were inflows there. Long-term Treasury ETFs, like the 20-plus ETF, saw inflows, but flattish on the shorter end of things. This is kind of tricky to figure out right now. What's the right way to look at this right now?
Yeah, I mean, this is a market where you have evolving monetary policy meeting with new fiscal policies from the administration that could prove to be quite inflationary and have an impact on interest rates. And that's why we still see interest rate volatility relatively elevated. I think in this type of marketplace, because you do have tight credit spreads too, where they're essentially 40% below long-term historical averages, this actually reinforces the case for active management within fixed income, to manage that rate volatility, but then also to use security selection to identify those credits that may have potential further upside from a credit spread valuation perspective. And I think On balance, though, what we've seen investors do in ETFs from a sector perspective has been piling into credit exposures because of the market environment that is still somewhat risk on and could be beneficial to those that are taking on risk in the form of credit, which is a sort of implied equity bias to it as well. But in the core, using active, I think, makes the most sense going forward to manage some of those risks.
You're an RIA. You know, what the average person going through this, would you recommend they change their portfolio? I mean, an average person whose aggressive portfolio might have 70% stocks, 20% bonds, and 5 or 10% other kinds of investments like cash and gold. Would you make a sudden move out of bonds or into bonds or anything like that? It seems like the best advice is almost to do nothing right now if you're confident in your allocation right now. Isn't that the most important thing?
Yeah, sometimes the best thing is to do nothing. You know, what I would say is that, you know, my inbox has been flooded from RIAs, advisors, you know, and retail investors, what they want to do. You know, our message has been consistent. Like, we went into this year very constructive. We said, look, you know, the earnings recession we had last year is over. The earnings environment is improving. Matt talked about that a little bit. You know, the Fed was going to cut, and then the average stocks valuation actually was not that expensive. So we've been trying to get advisors to kind of get out of bonds and money markets. There's still $6 trillion in money markets.
Yeah, they love those money market funds.
They love those money markets, but you know, the S&P. What has the S&P done in the last 2 years? Right, it's up 60%. Now it's being driven by Mag 7, but you know, there's so much emphasis on bonds and, you know, a lot of products being issued on bonds, but you know, equities, you know, we want advisors to own more equities, right? Maybe your 70-30 shouldn't be 70-30, maybe it should have been 80-20. And those are the conversations we're starting to have. So
yeah.
Be careful with bonds.
The other risk, we were talking about tariffs, but the other risk is valuations that are out there. I know you've spoken about this. President-elect Trump is going to inherit a stock market at the very top end of its valuation range. I mean, isn't it fair to say the easy money has been made in the S&P 500? I mean, how much? 50% in 18 months or 19 months? I don't know what else. I've been 34 years at CNBC. I've rarely ever seen anything like this. You know, you've been trying to get advisors to move ahead with this. You've called it a market clearing event, essentially. That's the problem I have at this point. How much more are you actually going to throw at this price into the market?
Yeah, for sure. And if you look at the earnings growth of the, let's say, the non-Mag 7 versus the Mag 7, you are starting to see incrementally, you know, the non-Mag 7 actually have higher earnings growth than the Mag 7. If you do any sort of quality filter on mid-cap, small-cap stocks, you know, you're looking at 13, 14 times earnings, S&P at 22 times. So, you know, that's kind of what we've been telling advisors too, is like, you don't have to go internationally and own Chinese equities, European equities, which still have a lot of risks, whether it's the Ukraine war, you know, tariffs in China. You know, there are value stocks, value themes in the U.S. So I think, you know, my sort of prediction in 4 years after Trump's presidency is that we're going to look back and say, okay, you know what, small caps actually did outperform large cap stocks.
Matt, we've talked about the stuff that's seeing flows, banks, small caps, industrials, cyclicals, crypto, non-Mag 7. What about 2025? Any surprise 2025 trades that are going to be we're not talking about now?
Yeah, I mean, I just listening to this past conversation, you'd maybe say the outside chance that maybe non-U.S. equities are the sort of contrarian idea,
yeah.
And maybe folks want to pile into non-U.S. equities for valuation reasons. I just think that's also sort of hard-pressed to think that will come true, just given the growth advantage within the U.S. I do think that you will see more flows into non-tech. I think you will see a broadening of earnings. You've already started to see that. I think you'll see more small cap, mid cap, more cyclically oriented industries, financials, industrials, consumer discretionary. So nothing really mostly a big surprise. I just think it won't be such a heliocentric market led by tech stocks. I think we will see broader depth in this sort of U.S. dominance. And, you know, again, that could be beneficial to the U.S. listed ETF industry, where we're starting to see more and more capital going in because mutual funds are in net outflows this year.
Yeah. That makes a lot of sense to me. I want to talk about that in the podcast that's coming up in just a moment. This has been a great discussion, folks. You see how fast things move in this business. Pay attention. When you see KRE, a big bank ETF, have 35% inflows of its total assets under management in one day, 35% of it in one day came in for that. That's how fast these things move right now, and you need to sort of have a plan and be on top of all of that.